What if I told you that there is actually no magic number in your bank account that directly cancels your pension in Canada, but there are still hidden rules that can quietly reduce your income if you're not careful? Many retirees hear warnings like, "Don't keep too much money in your account or you will lose your pension." That sounds scary, but the truth is more balanced and a lot more important to understand, because while your bank balance alone will not stop your Canada pension plan or old age security, what really matters is how your income is calculated, and that is where many seniors get caught off guard. Hello, and welcome back to Canada Pension Pro. Today we are going to clear up a very common misunderstanding that affects thousands of Canadian seniors. There is a lot of confusion online about whether keeping too much money in the bank can reduce or cancel your pension benefits like the Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement. So in this video, we are going to break it down in simple terms. What actually affects your pension? What does not affect your pension? And the real rules that matter when it comes to your retirement income in Canada. This is important because misunderstanding this can lead to poor financial decisions, unnecessary stress, or even missing out on benefits you are entitled to. Let's get straight to the key point. In Canada, your CPP and OAS payments are not reduced based on how much money you have sitting in your bank account. That means having $10,000 in savings or $100,000 in savings, or even more, does not automatically reduce your Canada Pension Plan payments. It also does not directly cancel your old age security. However, there is one major exception where money and income matter, and that is the Guaranteed Income Supplement. The program called Guaranteed Income Supplement, or GIS, is income tested. That means your yearly income can affect how much you receive. So the real issue is not your bank balance, but your taxable income. 4. Detailed breakdown. Let's go step by step so it is crystal clear. 1. CPP is not affected by savings or assets. The Canada Pension Plan is based on your contributions during your working life. It depends on how much you earned while working, how long you contributed when you start receiving it. It does not depend on bank savings, property, value, investments sitting idle. So you could have a large amount saved and your CPP would still remain the same. 2. OAS is mostly based on residency and income, not savings. Old age security works differently. To qualify, you need enough years of residency in Canada, but the important part is this. OAS can be reduced through something called the OAS recovery tax, often called the clawback. This only happens if your annual income goes above a certain level. It is not triggered by savings in your account, but by taxable income such as CPP payments, employment income if you are still working, withdrawals from RRSP or RRIF, investment income. So again, it is income, not bank balance, that matters. 3. GIS is where things become sensitive. Now here is where people often get confused. The Guaranteed Income Supplement is designed for low-income seniors who already receive OAS. Unlike CPP and OAS, GIS is income tested. This means if your income goes up, GIS goes down. If your income is low, GIS increases. But again, it is not your savings directly. However, savings can indirectly affect you because if you withdraw money from savings or investments, that withdrawal may count as income. So in practice, money sitting in your account is fine. Money you generate from investments or withdrawals can affect GIS. 4. The biggest misconception: too much money in the bank destroys your pension. This is not true in a direct sense. There is no rule in Canada that says if your bank balance is above X, your pension is cancelled. But here is what people misunderstand. Higher savings often generate income, such as interest dividends. Capital gains are RIF withdrawals, and that income can affect GIS and OAS clawback thresholds. So it is not the money itself, it is what the money produces. 5. Real-life impact. Let's make this practical. Imagine two retirees. Retiree A has $5,000 in savings. No investments. Very low income. Retiree B has $200,000 in savings. Investment portfolio, generating annual income. RRIF, withdrawals each year. Both receive CPP and OAS, but retiree B might receive lower GIS or possibly face partial OAS reduction depending on total income. Not because of the savings itself, but because of the income generated from those savings. This is where planning becomes important. 6. Presenter. Commentary. In my view, many retirees get stressed by online claims that sound absolute, like, keep under this amount or you lose your pension. But when you look at how the system actually works, it is much more flexible and less dramatic than that. That said, it is also true that income planning in retirement can make a real difference. A small change in withdrawals or investment strategy can affect monthly benefits, especially for seniors relying heavily on GIS. So this is less about fear and more about awareness. 7. Practical advice. Here are some simple things viewers should keep in mind. First, always separate savings from income. Your bank balance alone is not the problem. Second, understand what counts as taxable income. CPP, OAS, RRIF, withdrawals, and investment income all matter. Third, if you're receiving GIS, be extra careful with withdrawals and investment timing. Fourth, check official updates from Government of Canada, pension pages, service, Canada announcements, Canada, Revenue Agency tax guidelines. Finally, if your financial situation is complex, it may be worth speaking to a licensed financial advisor who understands retirement income planning in Canada. 8. Summary. Let's quickly recap the key points. There is no fixed bank balance that cancels CPP or OAS. CPP is based only on contributions, not savings. OAS can be reduced only if income is high enough. GIS is income tested and more sensitive to withdrawals and investment income. The real issue is income, not money sitting in your account. So the idea that too much money destroys your pension is misleading. The real story is about how income is structured in retirement. If you found this video helpful, make sure to subscribe to Canada Pension Pro for clear and simple updates on CPP, OAS, GIS, and other retirement benefits in Canada. Give this video a like if you want more content that explains pension rules in an easy-to-understand way. And feel free to share your questions or experiences in the comments. Your feedback helps us create more useful content for Canadian seniors. Thanks for watching, and I will see you in the next update.